Hey guys, welcome back. We're going to do something a little bit different today. We're going to step away from the high risk dApps that we've been talking about, although we will come back to them a bit later in the video. And I want to plant our feet a little bit more firmly in reality and talk about what kinds of returns are possible in DeFi as sustainable returns. And I want to take a wider view of crypto and DeFi and talk a little bit about where I think things are headed and where I see there being some opportunities. Because I think a lot of you guys who watch my videos, some of you may be new to DeFi, or maybe some of you have been around for a little while, but you may have been funneled through the YouTube algorithm into this kind of hamster wheel of just chasing the newest, most hyped, most risky plays, the things like miners and auto stakers we've been talking about, and ROI dApps. But really those things are kind of at the edge of DeFi, and in my opinion they're not really what DeFi as a whole is about. They do get a lot of coverage because not necessarily because they're great investments, but because they're profitable for content creators and early adopters to hype. There's a lot of money to be made just from hyping them. They tend to be really high risk. They tend to not be sustainable, and they're almost always filled with these kind of implicit or explicit promises that just are never delivered. And in my view, I don't think that exclusively following these apps is a great way to grow your wealth unless you've got a really high risk tolerance, and unless you're lucky enough or just to get in early on some of the big ones that tend to hit big, in which case you can make a ton of money. So these high risk, high reward plays, to me, they can feel a lot like gambling or playing the lottery. And there's nothing wrong, in my opinion, with gambling or in playing the lottery, but I just don't think it's a great idea to just pull out all your savings, take them into the casino, and see how things end up. I'm sure there are some lucky people who can build their fortune that way. They put it all on the roulette table and they walk away with a lot of money. But most people are going to end up losing a lot of money doing that kind of thing. And in general, I don't think it's a great way to invest, to just kind of run into the DeFi casino, put your chips down everywhere and hope that something pays off. So look, in my very first video for YouTube, I've just got a still from that up on the screen. I went through and outlined what my personal investment strategy is, and the reason I arrived at this is, in my opinion, it strikes a pretty good balance between risk, and growth and stability, as well as some opportunity for kind of higher risk and higher growth plays. And I do intend to come back to this at some point and revisit this approach and talk about what I've learned in the couple of months now since I've made that video. In the video, I talk about investing around 10% of my overall, investment balance. That's this part here into degen plays, and spreading that 10% over about 4 or 5 different apps just to control risk, so that if one fails, you don't lose all your money. And for me personally, that's what my risk appetite looks like, and how much I'm personally investing in these kinds of apps. So apps like Baked Beans and Auto Stakers, whatever. When I invest personally, I'm only investing a really small amount and trying to spread and diversify the risk. So remember, as I've spoken about, more than 50% of people lose money on high risk Ponzi-based apps. And if you don't like the word Ponzi, some people have called me up on that and think that I'm applying that too broadly. I've given my reasons in the comments for doing so. But if you don't like that word, we can call them zero-sum games. But most of the time, more than 50% of people are going to lose money. Most of the time, you're going to lose money. But if you are going to make money off them, you need to find some sort of edge over other players or other investors. And whether that's getting into a popular app early, or whether it's using the referral system to your advantage, or in the case of some of the ROI apps in the past, we've talked about some edges that you can get by accepting a slightly lower rate of return in exchange for getting your money out earlier and lowering your risk. So I've been able to make some money in those ways, but you need to be kind of really well considered and understand what you're doing with these high risk plays, and really to limit your exposure. Like I said, 10% for me is kind of a limit when I'm talking about these, because there's really an opportunity to lose a lot of money. In my opinion, the point of getting into these high risk plays is not going in all or nothing and trying to hit the big time, like I think a lot of people are with things like baked beans. Putting a lot of money in, just everything they have, and then trying to kind of get as much as possible. That's one way to do it for sure, but I don't think that's a very good way of doing it from a risk perspective. The way I approach these things is try to invest in a controlled, informed way, and basically by diversifying, by understanding what I'm doing, I'm hoping to, on the whole, on average, make pretty good returns, slightly better returns that I'm getting from these more stable, low risk methods. But that's the 10% of the money that I'm investing, but really where I've been spending the 90% or more of my time on YouTube to kind of talk about them. And the reason is that I find them really interesting, and I think finding edges and other plays for these degens is really interesting and fun. So I do intend to keep doing that. But just to offer some perspective here, the other 90% of my investments here, what I'm trying to do is grow them in more sustainable and predictable ways, and not just grow them, but also limit the opportunity for loss. And that loss can come from, the contract loss itself, if there's risk involved in that contract. And there's also market fluctuations if you're doing things like trading. You don't want to expose yourself to different risks all over the place. You need to be able to control them. But there's a whole world of DeFi outside of just this 10%, these high risk plays. And I think it's important to understand what that world of DeFi looks like and what kind of returns can be achieved by the more stable and low risk protocols, because what it helps you do is to come up with an overall investment strategy that's going to be sustainable over a longer time frame, one where your investments are always going to keep growing, and you're not just going to get wiped out by these market fluctuations, or one bad investment that you make just going to zero and taking out a large portion of your portfolio with it. And the other reason I think it's important to understand what these sustainable returns look like in DeFi is that it helps you cut through some of that hype and promises that get made, by some of these newer high risk apps. For example, they will say there's quote sustainable returns in things like CZ's Kitchen and Sphere Finance. Promising that those returns are going to be sustainable in the future. And the question you want to answer is, are they going to be anywhere near what you might be led to expect based on the hype around those protocols? So you only need to look at the rest of the DeFi and what's on offer, what is achievable, what's sustainable, to find out whether those promises are going to bear fruit. So in this video, what I wanted to look at is spotlight the Terra blockchain in general and the Anchor protocol specifically, and talk a little bit about those. And in future, I might go to some of these other investment strategies that I take. So what is Terra? So Terra is a blockchain, but it's not an EVM or an ethereal virtual machine. Which is basically a copy of Ethereum with some tweaks. And a lot of the chains that we look at or use in DeFi are actually EVMs, basically chains like Binance Smart Chain or Matic. Those are EVMs, and they're basically copies of Ethereum with some tweaks, and that makes them compatible with each other. That means you can use MetaMask for all of them, because they're all running on basically the same underlying software. So Terra is a little bit different. It's built out of the Cosmos SDK, and it's built differently from the ground up. It's not compatible with Ethereum. It's completely something else. And I think probably a lot of people have not really gone into Terra for that reason, because you can't just jump into MetaMask and use it the same way as you have all these others. You need to get a separate wallet set set up a new wallet and bridge funds across somehow using a bridge or a separate service or an exchange. So it's just not that easy to get into if you're already stuck in the or established, I should say, in the EVM world of DeFi. It's kind of easy to move around that world, but once you want to get onto these other chains, there's a bit of a slight barrier to entry. But apart from that, if you come from that background, you might find there is a barrier. But apart from that, Terra is actually very popular, and in my opinion, it's still a severely underrated and undervalued chain, even despite its popularity. So if we just have a look at CoinGecko as a starting point, if you look at the top cryptocurrency lists, you can see that number 9 is Luna, which is the native coin of the Terra blockchain. And number 10 is UST, which is the US dollar stablecoin on the Terra blockchain. And despite having the 9th and the 10th ranked coins, I don't think Terra gets talked about quite as often as some of these other coins with a lower market cap like AVAX, Polkadot. Definitely doesn't get talked about as much as Dogecoin. And for that reason, I think it's quite undervalued. And look, if you have a look at total value locked here on DeFi Llama, I think this is a really good view of DeFi, and something that you should look at and understand, especially if you're trading in coins on exchanges and not just doing DeFi. But if you have a look, Terra is actually the second largest chain by total value locked. You can see Ethereum with 106 billion, Terra just behind it here at over a quarter of that, $28 billion locked into Terra, which is a massive amount of money. You can see the next one here, third on the list, is Binance, that's BSC, with 12 billion, and Terra is it's more than double the third ranked chain here. But if you have a look at the market cap for those coins, you can see that actually BNB is ranked 4th with $63 billion in the market cap, and Terra is ranked 9th with 26 billion. So despite Terra having more than double the TVL as BNB has almost triple the market cap of Terra. So you can see, I think this is a good way of just kind of assessing what value a coin has, using TVL as a approximation of value, of the value of that chain, how much money is actually in that chain and active on that chain to derive that value. And from using that as a metric, I think Terra is still quite undervalued, despite the fact that it's had a lot of growth in recent months. Yeah, and especially that's true when you compare it to something like Cardano, which somehow is still ranked 8th, despite the fact that if you look at TVL, it's all the way down at number 32, with a mere 201 million TVL. So I think this is a really good and useful view if you want to try and gauge the relative value between chains. And actually, let's take a quick look at the Terra price performance. I don't normally talk about coin prices on the channel, but I think just as a view of interesting fact about Terra and how it performs Luna, and how it performs price wise, and what we can learn about that. If you have a look at say Bitcoin as a starting point, we can see it hit a peak back in November, and it follows this kind of downward trend to a bottom in January with a slight increase and then a downtick. That's been Bitcoin over the last few months. And you look at Ethereum, it's basically the same curve. It's pretty much the same thing as in crypto. These coins tend to follow each other. Cardano, very similar curve, although Cardano I think has had a lower subsequent peak, just because of the fact that these so much of this price is built on hype and promises that has just not really turned into reality. So I think this is going to continue to drop a little bit differently to other crypto chains and coins, but you can see again, regardless, this same pattern is borne out all over the place. AVAX, BNB, and Matic following similar paths. And we look at Luna, and it's a little bit different. You know, it does have some of the similar characteristics, but it did have a bit of a period of growth here early on in the year. This is, it's kind of bucked the trend a little bit. And even beyond that, when we've seen downward trends and upward trends, it's been a little bit of a different trajectory, and it's been slightly performing slightly differently to these other coins. Yeah, and so when it comes to price action, I think the differences are hard to explain. I mean, you might say a lot of it's due to just bullish sentiment around Terra, which is very true. It did pick up a lot of steam, but you might also say that it has something to do with Terra's unique features, and one of which is the relationship between that Luna coin, the native coin on the Terra blockchain, Luna, and UST, which is Terra's US dollar stablecoin, as I've said. So those two have a specific relationship that's built into the code of the blockchain. So UST, it's an algorithmic stablecoin, and what that means is it's not actually backed by dollars. So you have USD coin, you have Tether. Those are backed by a reserve of actual US dollars. It's maybe not 100% reserve, but it is I believe close to a partial or a full reserve. And the idea there is that you can always exchange your USD or your Tether back for US dollars if you need to. So UST is different. It's not backed by US dollars. It relies on an algorithm to keep that peg, which in turn relies on arbitrage. So it does that by essentially making it in people's interests to maintain that peg. And the interaction is pretty complex, and I don't really want to go into a lot of detail in this video because it's not really what I'm here to talk about. But if you're interested, it's definitely worth looking into. What happens at a high level is basically you can exchange Luna for UST at any time at a UST value of $1. And what that does is create these arbitrage opportunities, and it makes sure that the value of the UST stays pegged pretty closely to $1. And the other side effect of this process is that when those exchanges happen, depending on the direction, when UST, for example, is minted, Luna is destroyed, and vice versa. So it means there's a relationship between these two coins and tokens, just by virtue of this arbitrage kind of peg maintenance process. And it's difficult to work out exactly what that impact might have on the price, but it's fair to expect that when the demand for UST is high, because you're minting new UST, you're also burning Luna, and the price of Luna might also go up. And at the moment, there's about 16 billion locked in the Anchor protocol, and that's what helps drive that price of Luna up significantly. And look, just as I've been following these charts and making various trades between Luna and UST, I've noticed that Luna is often insulated from the volatility of the crypto markets a lot of the time for that exact reason. And one reason might be that when the market is dropping, Luna holders are converting their Luna to UST, depositing that UST into Anchor and waiting for a buying opportunity. And since that increases the demand for UST, it basically burns more Luna, and that reduces the impact of that sale on the price, and keeps the price sustained a little bit higher than if that mechanism didn't exist. And that's actually a strategy that I follow when I am trying to build my holding in Luna. Basically, when the price of Luna is high, what I start to do is progressively sell that off, basically dollar cost average out of Luna into UST, deposit that UST in Anchor so it earns some percentage yield to offset any fees, and to just kind of add slightly to my holdings. Then when the price starts dropping, as it has been, what I do is progressively dollar cost average out of Anchor back into out of Anchor back into Luna to take advantage of the lower price, so that I can then capitalize when it goes up. So, the way that the crypto market is going, it's not hitting heights. It's and for reasons I'll go into this video, I don't think it'll do it for quite some time, and we might be in this stage of kind of ups and downs for a while. So I think as an investor, it makes sense to take advantage of these ups and downs and try to kind of squeeze a little bit of extra returns when you can. And I found that this is a good method of just generating a little bit of additional value just by the market moving up and down as it normally does, and you're dealing with kind of relatively stable assets and relatively high value assets, so I think the risk is fairly low. But I realize I haven't actually explained what Anchor is, and I'm already talking about it, so let's kind of move over to Anchor. And I think the best way to think about Anchor is it's basically like a bank. So you deposit your UST and it pays an interest rate. And if you go to the Earn tab here, you can see that interest rate at the moment is about 18%, and that's per year. But for many months, it was hovering around 19.5%. But it has dropped down slightly. So Anchor pays a return on your UST investment of 18% a year. And how does it do it? Does it rely on new investors coming in to add to the contract balance like a lot of the Ponzi apps that we've been looking at? And the answer is no. It operates like a bank in many ways. And what it does is it lends money out at a certain interest rate, and you can look at the Borrow tab and you can see the amount that you pay. You need to pay back in interest when you borrow money out of the Anchor protocol. So there are people who borrow money, and the returns made go to some way of paying that 20% or that 18% APY. The other way of making money is when you borrow money, you can also hold deposit collateral, and that collateral comes in the form of other coins. So that's Luna, essentially bonded Luna, bonded ETH, Atom, and AVAX. And the Anchor protocol makes money based on staking returns from those assets that it holds. So it makes a certain yield on those assets. It makes a certain amount of income on the lending, and then it pays that back in an APY here to people who are invested. So there, it has methods of stable and sustainable returns. But is the rate of 18% sustainable? The answer is no. And that's because the amount of the returns that can be made off things like lending and asset staking are much lower. And generally speaking, I'm not sure what the balance sheet looks like for Anchor in particular, but generally speaking in DeFi, you expect rates somewhere much closer to the 8 to 10% range. Even that might be a little bit on the high end of the range, but that's more of a realistic return in DeFi. So 18% is too high and it's not sustainable. But the way Anchor works is that it has a yield reserve. So if we go back to the dashboard, you can see what its yield reserve is. At the moment, the yield reserve is 184 million. And we have total deposits in Anchor of around $14 billion in UST. So this is different to, again, the other DeFi kind of Ponzi-based contracts we've been looking at, where the amount that's invested in the contract simply isn't there, and you're relying on new investors to come in and pay that while people are taking money out. This is different. This is more like a bank account, and that amount actually just sits in there. That's amount that is sitting in there, and you can withdraw that anytime you like. So if you've got money in Anchor, you can basically pull that money out when you like. You can invest it when you like. There's a transaction fee associated, but there's no other exit or entry fees. It's really simple. And the way that percentage of 18% is paid back or paid is through this yield reserve. And this yield reserve is built up from the returns from lending and from staking that it makes. And that increases the yield reserve, and that allows that to be paid out at that APY in addition to the amount that's held in deposits. And What happens over time is that this APY may not be sustainable. They may not have the funds to continue to pay that out, but all that happens is that they continually lower that APY until it becomes more sustainable, and that there is always money in the yield reserve to pay that back and to pay back the initial deposit. So it's not that Ponzonomics where you at any point you're going to run out of money. You're not going to be able to get your initial investment back. That's just not the case with the way that Anchor is set up. And additionally to that, there's the Terra Foundation has received influx of money onto the yield reserve, basically investments onto that yield reserve, to keep that high and to make sure it does keep paying out at this high rate, because there is basically an incentive for them to do so. The more people enter this Terra system, remove that barrier of entry to getting their money into the system, the more they can build Terra as a blockchain in a number of different ways that they're planning. So that's why they absolutely want to keep that rate high and maintain the returns as high as possible for as long as possible. But the bottom line is that when you're investing in Terra, in Anchor, you're not in a Ponzi. You're not basically risking your deposit. You're not going to lose your money as long as that UST peg basically maintains. You can always pull out your deposit at any time. All that is variable is the amount of interest rate you're going to get back from that investment, and that's really what I like about Anchor, and I'd say Terra in general. It is the simplicity and the broad appeal of this kind of protocol. So, look, in my opinion, crypto and DeFi at the moment, they're in a bit of a rut. There hasn't been a whole lot of sustained growth. There's obviously been spikes in price, and interest comes and goes, but in terms of sustained growth and real growth within ecosystems, it's been a lot slower, and I think a lot of that has to do with public perception. If you talk about crypto to people outside of crypto, many will basically just think it's a scam, or they'll think of things like NFTs, which are on their face really stupid, and another subset of people will just think of crypto as meaning Bitcoin itself. And in my view, Bitcoin is a bit of a dead end. It's not a smart contract based blockchain, and in general I wish people would stop talking about it and confusing crypto with Bitcoin, because I don't think Bitcoin really has any kind of future beyond name recognition and just the momentum that it has from being the first and being the most recognizable name. And when I hear about some companies allowing payments in Bitcoin, or in some cases even countries adopting Bitcoin as a national currency, it doesn't really make much sense to me. It's Bitcoin is clunky, it's expensive, it's volatile, it has very limited functionality, and it's not a really good transactional currency. So I don't think the future of crypto and the future of definitely not the future of DeFi, the future of crypto, I don't think it's actually in Bitcoin. I think although we'll see some price rises continue, very likely that'll keep going. I think long term the market share of crypto is gonna keep coming down, and I think for me the promise of crypto is really in DeFi, and to fulfill that promise, it needs to come from a point of simplicity, familiarity, and stability. And I think that stablecoins are going to be fundamental to crypto adoption. So no one wants to be constantly converting between their native currency and whatever coin you want to deal with, and exposing yourself to market fluctuations and conversions and all that kind of thing. And I think familiarity, understanding, and ease of use are really critical. So being able to get your money into the system, being able to transact easily and securely, these things are going to be really fundamental to crypto being adopted. And these are the directions and opportunities that I think that Terra is actively seeking. And looking at the Terra blockchain, I can see a chain that's actually actively moving in the direction that I think crypto needs to go. there is an app that is relatively new called Alice, and that's trying to create a bridge between traditional banking and Anchor, essentially an easy on-ramp to get your money into Anchor without dealing with all of the extras that you generally need to for DeFi. It's basically just how to get your money straight out of your bank and into Anchor. And what I love about Anchor specifically is that it's such an easy proposition for someone outside of DeFi to grasp. So it's a digital bank. It pays yield somewhere around 10 to 20%. And if you go to your traditional bank, you'll know that if you've got your money in a deposit account, you'll be very lucky to get 1%, and it's probably going to be a fraction of that. So, you might not think that 10% or 20% a year is all that great, but when you compare it to traditional finance, it is really high. And it's just about as high as you're going to get with any kind of stable investment in traditional finance, or higher than any kind of stable investment in traditional finance at a very reasonable risk. So Anchor makes it really easy to deposit and to withdraw. All you need to do is basically click a button, and you're done. So deposit, withdraw. There's no tricks. There's no weird lock periods or fees or other games or anything complex that I think, when we talk about all these really complicated protocols, I think a lot of the time are there just to hide what they're doing and try to make it look like they're good investments, but they're not. This is really easy. You deposit, you withdraw whenever you like. It's cheap, it's easy, there's no fees, and it will tell you how much you're going to make in a month, in a year, whatever it is. So I think that's a really major advantage of Anchor. I can tell my mum that how to invest in Anchor and explain the benefits of doing so, or someone who's not in the DeFi world, they can look at this and say, well, this is understandable. It's simple. As long as there's an easy way of getting your money in there, the rest of it kind of works itself out. Yeah. So what Anchor becomes is something like an on-ramp for the Terra ecosystem. And I haven't talked about the rest of the Terra ecosystem, but look, there are a lot of great apps out there. Mirror is one notable one. It lets you essentially trade in algorithmic versions, mirrored assets, they call them, of real life assets. So you can see here we've got stocks, we've got Apple, Airbnb, AMD, Amazon, and the prices of these assets go up and down, correlated to the real life assets. So you can essentially you can play the stock market entirely within DeFi, entirely within the Terra ecosystem. There's a limited number of assets at the moment, but that's going to increase. You can even take short positions, hedge positions, leverage positions. There's a lot that you can do there. And I think that just the power of being able to do all of this outside of traditional finance is really powerful. And within the Terra Station app, you can just see there's a lot of other currencies. So apart from UST, which is linked to the US dollar, you've got AUT linked to the Australian dollar, Canadian, Chinese, Swiss, the euro, the pound, basically a bunch of other currencies from different countries. And that means that you can extend these stablecoin benefits transacting in your native currency around the world. Not to mention you can do forex trading or whatever you want to do within this ecosystem. So the power, the promise of this, I think is really great. So it's all about this building of this kind of fully fledged DeFi ecosystem, linking into real world assets, prioritizing things like simplicity, practicality, ease of use, and full of features and concepts that can really be easily understood and implemented, really understood by the public. And I think it makes a much better proposition for trying to get DeFi out there and get adoption into crypto. In the wider public, it's much easier when you're talking about something like this than when you're talking about really weird, really kind of gambly DeFi on other chains. So these are the reasons I think that Terra is such a compelling proposition. And for me, it's something that's worth getting excited about and worth talking about and getting people into. But are there risks? Of course, there are always risks. You're in DeFi, there's always DeFi-related risks, like just the fact that you are in control of your own money. There's no guarantees. There's no insurance. If you send money to the wrong wallet, it's gone. If you lose your keys, your money's gone. All of that is still there. That's one risk. Another risk is this reliance on algorithmic stablecoins, which in this case is UST and the other versions related to other local currencies. And this is a fairly new technology, and it's fairly unproven. Terra and UST has been around for a while, and it's recovered from a few crashes, and it's proved itself to be stable in, I would say, the medium term, or in crypto, medium to long term. But there is still a risk of catastrophic failure. There's still a risk that everything goes to zero, and that risk is non-zero. And I would always take that into consideration. For my own self, my own risk appetite, I wouldn't invest more than like 20 to 30% of my portfolio in Anchor, because you just never know what's going to happen to UST. You have to, if you're going to invest in something like this, you need to be alert to any changes, any potential issues that might make Anchor a risky proposition. But that's something you need to be aware of. The other risk is regulation. So stable coins and mirrored assets, in my opinion, are a much high risk target for regulation than just crypto in general. So just think about what mirror finance might represent to regulators. Just if you're a high-level executive, say in Microsoft, and you had some inside information, say there's an upcoming merger and you knew was going to bump up the share price, well, you couldn't just go and buy some shares in Microsoft, because that would be insider trading. You would have issues trying to do that. But if you could fairly anonymously purchase some shares in Microsoft via Anchor. Here we go, Microsoft Corporation. Indirectly, you're not actually purchasing Microsoft shares. You're purchasing a mirrored asset, and you can still take advantage of that insider information. So, I think this kind of thing, as things like Mirror Protocol grow in popularity, as they start to kind of become an alternative to traditional finance a little bit more, then I think regulation starts to look inevitable, because the government needs to close those kind of loopholes. So there is always that long-term risk there that you need to be aware of, as well. And with regulation, you just never know which direction it's going to go. Is it going to become like an outright banning, or is it going to be some other mechanism that still kind of allows these to thrive? That's a really big unknown. And I think for Terra, it's bigger than it might be for other blockchains as well. And the other risk to talk about is just the amount of dependency that Terra has in Anchor. So 28 billion locked in Terra, and in Anchor we have 16 billion of that locked. So that's more than half of the value of the entire Terra ecosystem is in Anchor. So that presents a risk, definitely, because if you start to see the rate drop, if this no longer is a good investment proposition for investors, you might see the overall price of Luna drop as that TVL drops. And that's again why there's an incentive for the Terra Foundation to maintain that APY for as long as possible while they build out the ecosystem and deliver other value propositions within the Terra ecosystem to keep people in there. There are definitely other, there's definitely other value propositions, like I've said, Mirror. I'm not going to cover them all in this video. There's other interesting apps on the Terra ecosystem, but a lot of the value, as you can see right now, just comes directly from Anchor. So that is also a risk. But I think with Terra as a long-term investment, you're investing in that promise of a stablecoin ecosystem, easy on-ramps, simplify DeFi, make it accessible, and an attractive prospect to the general public. And, I don't know whether Terra is going to fulfill this promise itself. I don't know if Terra is going to become that core platform that kind of bridges the gap into regular between crypto and regular traditional finance, whether it becomes an alternative that people in the general public can see a value in and put money into and kind of grow. I don't know if Terra itself is going to fulfill that promise, but it's definitely a step in the right direction, which is why I think it's really interesting. And for me, it's something that I'm willing to invest in at the moment. All right. So with all that being said about Terra and why I'm into Terra, why I'm into Anchor, and it's these other protocols on the Terra ecosystem, I just wanted to come back to the question of high risk DeFi apps that we've been talking about on other chains, and what can Terra show us that we can apply when we want to evaluate some of those more risky apps. So the thing I want to focus on is that, remember, in DeFi, 18% return a year is unsustainably high. Like that's high through traditional means. It's very difficult to sustain something like that for months or even years, and this number will come down, to somewhere more realistic, maybe around 5 to 10%, which is more in line with staking returns, and that's fundamentally what DeFi growth is built on in some way. So when we look at things like miners that promise 8% a day, or auto stakers that promise hundreds of thousands of percent a year, we know that they're not going to come close to being sustainable at that rate. And the only way to, in my opinion, to approach those investments is just to consider them as those zero-sum games, apply the rules of Ponzinomics, which are to get in early, make sure there's enough people following you to make it profitable, make sure you sell reasonably early for a profit and not keep holding the bag. So I want to look at a couple of different apps here, and one of them I've spoken about already is CZ's Kitchen, and I think that seems to be kind of dying a bit of a slow death. I checked this earlier, had some initial buy-in and then just zero investment. So, and don't know if anyone's investing in CZ's Kitchen, but I'm using it as a representative here, and also Sphere Finance, which I've spoken about. And the promise here is that you get in and you make this return, or you make the 99,000% return for Sphere Finance, and they acknowledge that, yeah, sure, it's not sustainable, but we're going to start incorporating external sources of value. And I think it's important to recognize that there's this kind of psychological trick being pulled here. So I'd call it an implicit bait and switch. And this is not to accuse any of these protocols or anyone else of kind of fraud or false advertising or an explicit promise being made. It's more of a kind of psychological priming that I think you need to be aware of. And it's actually a common negotiating tactic, which is the first person to set the price in a negotiation frames the whole negotiation and forces the other party to respond in terms of the stated price. So by putting a price out there, you're kind of getting that into the mind of the other person, and you're setting that price as a benchmark for further discussion. And there's a similar thing happening, I see, with these apps. So Sphere here is offering 99,900% returns initially, which they say is not sustainable, and we're going to lower it. It's kind of an introductory rate. We run this for a while, and then we kind of lower it to what they call the perpetual rate. As they add sustainable sources of value, that rate reduces to the perpetual rate. But it's kind of a bit late, because they've already got you thinking in terms of this 99,000%. So whatever the real returns are, or what you kind of perceive those future returns are going to be, you're already framing them in terms of the expectation, in terms of this number, right? And you might think, well, 99,000%, I know that's too high. I know it's going to come down a lot, but still kind of in your mind, you correlate that. And you might think, if it's not 99,000%, well, maybe it's 1,000%. Maybe it's like a tiny percentage of that. Or for CZ's Kitchen or similar contracts here, you might say, well, yeah, we know it's not going to be 8% a week. Maybe it'll be, 8% a day. Maybe it'll be 8% a week, or maybe it'll be 1% a day, or maybe it will be, 8% a month, or something much more reasonable, because you've been framed, or you've been primed to view returns for this app within this frame. But in reality, it's probably not going to be either of those numbers. And that's what we can learn from something like Anchor Protocol. So even if they do manage to implement all of these profitable sources of income that they promise, the end result is unlikely to be any higher than that 5 to 10% a year that you can realistically expect within DeFi. And the reality is it's probably going to be lower than 5% because a lot of the methods of income that they talk about here are usually new, they're innovative, they're untested, and so there's going to be an amount of risk that comes with them. So it's quite unlikely that they manage to achieve stable yields similar to other areas of DeFi. So understand this trick, this kind of implicit bait and switch, that you see this number, you frame your expectation on that, even though you know that you're not going to get to this number. You might think, oh, well, I'm going to get a percentage of that. I'm going to get a small percentage of that. The only way to kind of view this is to forget about this entirely and just think in terms of what is actually achievable. Go back to Anchor and say, this is achievable, but it's also, it's not even sustainable. So that's the kind of frame that I think is valuable. Forget about any kind of promises. Just think to yourself, when you're thinking about investing in an unknown platform and you're trying to, work out whether it's a good investment, ask yourself, if I'm not early, if I'm not treating this as a Ponzi, I believe in the long-term future of the protocol, would I still invest in it at the inherent risk that is being offered if I am getting a realistic return? So say 10%, right? So if your expectation is that you're getting 10% returns annually on Sphere Finance as an example, would you still invest in it? And if the answer is no, then you might want to wait until you can see real returns being demonstrated. And if the answer is yes, I would still absolutely invest in Sphere Finance at 10%. Well, the follow-up question is, why wouldn't you just invest in something that's offering better returns at a lower risk? So look, that's what it comes down to for me. Having realistic expectations and understanding of what can be done in DeFi. DeFi is complicated. It's not magic. High returns usually come with a very high risk of loss. And long-term sustainable returns of, even modest amounts like 20% a year, 10% a year, even those amounts are hard to maintain and hard to guarantee without risk of loss. So I think to be successful as an investor, you need to be able to separate what's realistic and what's achievable from what's kind of smoke and mirrors and promises. You need to be able to separate what's a short-term play versus what's a long-term play. You don't want to put long-term investment money into short-term plays because you're going to misidentify them. You're going to end up holding the bag on those ones. And you don't want to fall for promises and bait and switch tactics. I think this kind of priming of your expectations that we see a lot when you see something with a really high APY. And look, I've unfairly singled out Sphere Finance here. Titano's done the same. Libero's done the same. You move from a really high expectation down to kind of a promise of something sustainable, but the promise of something sustainable has nothing to do with the high interest rate, and you need to be able to kind of understand that and not fall for this psychological trick. So, hopefully some of the ideas in this video are going to help you when you're evaluating some of these new investment opportunities, not to fall for these kinds of bait and switches. And hopefully this video has been of some benefit to you. All right. So thanks for watching. I know I've been off for a little while. Work has been crazy. My wife has COVID. I'm trying to find time for everything, but time is short at the moment. But rest assured, I will be back with another video as soon as I can. Until then, thanks very much for watching. Really appreciate your support, and I'll see you in the next video.